Welcome back to the deep dive. Today we're digging into Sempra Energy, ticker SRE, a huge player in North American energy, trading around $91.44 as of October 7th, 2025. Now, Sempra, they control, the essential pipes and wires for California and Texas to massive high-growth economies. But they just made a really dramatic move, selling off a big piece of their high-growth LNG infrastructure business. So that sets up the big question for investors. Was this a brilliant move to de-risk the company, making it the stable backbone for the energy transition? Or did they just sell off their best growth engine, right when the energy market was peaking? And the market signals are, well, they're really weird. You've got this huge split where analysts mostly love the company, but their average price target says the stock is actually overpriced right now by more than 11%. It's confusing.
Yeah, that contradiction is exactly what we need to unpack today. Our mission is to cut through that noise, look hard at the fundamentals, the business, the financials, management, the risks, and figure out if this premium price tag actually makes sense. Who's right? The bulls buying the stock or the math saying it's too high?
Right. And before we jump in, just a quick note. This deep dive is a priority for our Stock Analytics AI members. We're planning to cover all the S&P 500 stocks over the next few months, and members get that priority access. If you'd like a one-off deep dive like this one, just drop us a super tell.
Thanks. Okay, let's get started with Chapter 1. Business Understanding. When you look under the hood at Sempra, it's not just your standard, boring utility company. It's this powerful hybrid.
Exactly. It's like they've combined two different financial DNAs on purpose. You get the rock-solid stability from the regulated utilities, think predictable, almost bond-like cash flows. And then you bolt on the potential for high growth and high returns from building these massive infrastructure projects. That's where the expansion comes from. And the sheer size of it is pretty incredible, built on these three main platforms that really define energy delivery in North America.
Let's break them down. First up is Sempra California. That covers San Diego Gas and Electric and SoCalGas. They serve something like 25 million consumers.
Wow.
And SoCalGas, just for context, is the biggest natural gas utility in the whole country. That's serious scale.
Okay.
Second platform, Sempra Texas. That's their stake in Oncor, which runs the largest electric transmission and distribution network in Texas. Serves about 13 million Texans. And the third piece, the one they're strategically shifting right now, is Sempra Infrastructure. That's been their global growth arm, focused on huge energy export projects, mostly LNG, like Cameron LNG and Port Arthur LNG.
Okay, so that scale immediately tells you about their competitive advantage, their moat, right? Almost $100 billion in assets, and they're the only game in town for energy delivery in these huge areas. It's basically a regulatory moat.
Precisely. For those millions of utility customers, switching providers isn't really an option. You can't just swap out your gas lines or the power grid. So Sempra operates as a regulated monopoly.
Right.
Their baseline earnings are pretty much set by regulatory bodies, like the CPUC in California and the PUCT in Texas. It means they have guaranteed customers and a set return on their investments.
And this setup positions them perfectly for some of the biggest trends shaping the world right now.
Or absolutely. The tailwinds are strong. First, you got global electrification and decarbonization. The current grid just can't handle it.
No way.
So you need massive grid expansion. Estimates are over $600 billion needed in the U.S. alone by 2030 for transmission and distribution. Sempra, sitting in California and Texas, is right in the middle of that. Second, energy security concerns mean there's huge global demand for reliable U.S. LNG. That's a long-term boost for the remaining infrastructure assets. And third, the explosion in AI and data centers.
Which use insane amounts of power.
Exactly. They guzzle electricity. And that's turning Texas and California into ground zero for grid upgrades. Supporting the tech sector is now a key strategic goal for them.
Which leads us right into Chapter 2, Management Evaluation. How is the leadership team planning to actually capture all this opportunity? We know they've got stability, the CEO, Jeffrey Martin, CFO, Karen Sedgwick, they've been there for decades. But the really big story is that huge decision they made in September 2025.
Yes, that sale of a 45% stake in Sempra Infrastructure Partners to KKR for $10 billion cash. That wasn't just a minor adjustment. It's a fundamental change in direction.
So what's the thinking there? Are they basically trading growth potential for safety?
That's pretty much it. They are deliberately choosing predictability over volatility. Management wants Sempra's earnings, going forward, to be about 95% derived from those stable, regulated U.S. utilities.
95%.
Yeah. The KKR deal simplifies the business, reduces risk, less regulatory complexity, and crucially, it brings in $10 billion in cash to fund their huge spending plans without having to issue more stock and dilute shareholders. They're becoming more of a pure utility company that just happens to own a very valuable slice of a global energy business.
Okay, the strategy makes sense. Focus, stability. But looking at their track record on efficiency, well, that seems like a big challenge as they try to execute this.
It is. There's a definite performance gap. Despite the plans, Sempra's returns on investment have historically trailed the industry. Their trailing ROI is only about 2.5%. Yeah, compared to the industry average of around 4.4%, that's a significant difference. It puts huge pressure on them to get much, much more efficient with that massive $56 billion spending plan if they want to deliver for investors.
But there's one thing investors can count on, right?
Yeah,
The dividend.
the dividend is solid. Sempra's got a great track record there, 15 straight years of increases. The yield is around 2.86%. Payout ratio is sustainable at about 58-59%. That commitment to returning cash to shareholders, that's definitely a core part of their value proposition.
All right, let's shift gears smoothly into Chapter 3. Financial analysis, because these big plans need serious funding. Let's talk debt first.
Well, the debt load is high, no doubt. But that's pretty typical for this kind of capital-intensive infrastructure sector. You see the big difference between the market cap, around $60 billion, and the enterprise value, closer to $93 billion. That gap is mostly debt. Their debt-to-equity ratio is just under 1, around 0.98. That's common for utilities using rate-based financing, but it does put Sempra near the upper end of where they probably want to be on leverage.
And looking at revenue, it kind of tells the story of why management wanted to sell part of that infrastructure business, doesn't it?
Absolutely. Sempra had strong growth for a while, but then revenue dropped sharply in 2024, down over 21%. That kind of up and down is exactly what they're trying to smooth out with the KKR deal, trading that unpredictability for steady, regulated returns.
Now, the number that probably jumps out at anyone looking at the financials is the huge, consistently negative free cash flow. Negative $3.3 billion in 2024. Why isn't that a massive red flag?
It would be terrifying for almost any other company.
Yeah.
But for Sempra, it's actually part of the plan. They're in the middle of this incredibly aggressive, multi-year $56 billion capital spending program.
$56 billion.
Yeah. So they are deliberately choosing to not generate free cash right now. Instead, they're pouring every available dollar into building future assets that will generate regulated returns down the road. They're funding it with debt, the cash flow for their existing utilities, and strategic sales like that KKR deal.
So reinvesting heavily in future growth. But burning cash that fast must put some pressure on their short-term financial health.
It does. And that's where you see the weak liquidity. Their current ratio is only 0.48.
Oof, below 1.
Right. A ratio below 1.0 means their current assets don't cover their current liabilities. Now, that doesn't mean they can't pay their bills today. But it does mean if something unexpected happens, maybe a delay in getting a rate increase approved, a big storm, interest rates spike, suddenly they don't have much cushion. They're really counting on being able to access the capital markets smoothly.
And you see that underlying bumpiness reflected in their earnings per share over the last decade, too. It's been volatile. Even with that, though, the price-to-earnings ratio, the TTM/PE, is 22.0. That's actually a bit higher than the peer average of around 20.4x. Okay, let's move into Chapter 4. Market sentiment. We've got the fundamentals down. How does Wall Street see Sempra right now? The analyst ratings look really positive on the surface.
Yeah, overwhelmingly positive. It's a strong buy consensus. Out of 39 analysts covering the stock, 23 rated a buy, 16 are hold, and importantly, 0 say sell. Sounds pretty bullish, right?
Totally. But like we mentioned at the top, the numbers just don't match the ratings. It's bizarre.
It's a really stark contradiction. They slap a buy rating on it, but then you look at their average 12-month price target. It's only $81.12.
And the stock's trading over $91.
Exactly. So the analysts are basically saying, we like the company long term, but right now the stock is already more than 11% overpriced. It feels like they're saying the market got way too enthusiastic, too fast.
Technically, the stock chart looks strong. Momentum's good. It's trading almost 18% above its 200-day moving average. But maybe there's some quiet pushback happening.
We are seeing signs of growing skepticism. Yeah. Short interest is still low overall, only 1.85%. But importantly, the number of shares being sold short has been climbing pretty steadily and significantly since late July 2025. This suggests there's a growing, maybe quieter, group of investors betting that the price is going to come down from these levels.
Interesting. Let's look into Chapter 5, ownership structure. We know it's mostly big institutions holding the stock.
That's right. Very typical for a big S&P 500 company. Over 91.5% is owned by institutions. Think Vanguard, BlackRock.
Yeah.
That usually provides a lot of stability since they tend to be long-term passive holders.
Okay, but the real signal often comes from the insiders, right? The
Yeah.
people running the company.
And this is where that disconnect between the market price and maybe internal views gets really interesting. Insiders own a tiny fraction, just 0.27% of the company.
Tiny.
But even more telling is the buying versus selling. Over the last year, insiders have been net sellers by a massive 18-to-1 ratio. They sold almost $12 million worth of stock and only bought about $650,000 worth.
18 to 1. Wow. Is that just normal selling for compensation and taxes, or is that the leadership basically signaling that $91 is too rich?
You know, some selling is always expected, but an 18-to-1 ratio, that scale, that consistency, it's hard not to read that as the people who know the company best maybe don't see the stock as a screaming buy at this current price. It definitely casts some doubt on the market's current enthusiasm.
Yeah, that's a tough signal to ignore. Okay, let's talk risk. Chapter 6, Risk Assessment. Given where they operate, California, the Gulf Coast, what are the biggest threats?
Well, the really big, almost existential threats are external and potentially catastrophic. Being so concentrated in California means massive, potentially uncapped liability risk from wildfires.
We all remember PG&E.
Exactly.
Yeah.
Just the nightmare scenario, a reminder that even a regulated monopoly isn't immune if a disaster is big enough. And then along the Gulf Coast, they face increasing risk from major hurricanes hitting their LNG facilities. Those are huge potential hits.
And they're totally dependent on those regulators we talked about earlier, the CPUC and PUCT.
Absolutely. If those commissions made unfavorable decisions on rate cases, basically deciding how much profit Sempra can earn on its investments that directly hits the bottom line, regulatory risk is just baked into their business model.
And financially, that huge CapEx plan, that $56 billion spend, creates its own set of risks.
For sure. Rising interest rates are a constant worry. Every little increase in rates adds millions to the cost of borrowing for those huge multi-billion-dollar projects. That squeezes profitability.
Makes sense.
And then there's inflation. It drives up the cost of everything they need: steel, copper, skilled labor. That can mess with the economics of the whole build-out plan.
And there's a specific new cost pressure too, right? Something geopolitical.
That's right. There's a new 25% U.S. tariff on imported medium and heavy-duty trucks that kicks in November 1st, 2025. Sempra and their contractors need fleets of these specialized trucks for construction and maintenance. This tariff is just going to make that whole multi-year build-out more expensive.
Okay, let's pull it all together. Chapter 7, Conclusion. Let's restate the bull case, the story supporting that $91 stock price.
Right, the bull story is compelling. Management's made a clear, decisive pivot to about 95% stable, predictable, regulated earnings. They've secured $10 billion in cash from KKR without selling stock. And they're positioned right in the sweet spot of huge trends: AI, electrification, LNG demand.
Yeah.
They aim to be the essential energy backbone.
Makes sense. And the bear case. The reasons for caution, the things justifying the analyst price targets, and maybe that insider selling.
The risks are very real. There's the execution risk. Can they actually deliver on that enormous $56 billion CapEx plan efficiently? There's the weak short-term liquidity, that low 0.48 current ratio, high debt levels. And always lurking is that potentially catastrophic wildfire liability in California.
So let's ground this in valuations. Sempra's trading today at $91.44.
And based on our educational discounted cash flow model, the estimated intrinsic value comes out somewhere between $76.80 and $77.50 per share.
Okay, so Sempra is currently trading at roughly an 18 to 19% premium compared to that DCF value range. The bottom line seems pretty clear. Today's market price already assumes everything goes right. It assumes perfect execution of the strategy shift and the huge CapEx plan. You're paying a premium price for that optimistic outcome.
Which leads us to a final provocative thought for you, the listener, to chew on. Sempra has made this very clear move towards being a lower-risk regulated utility. Is it possible the market is already valuing it using a higher, more premium utility multiple because of that shift? And if so, can they actually get favorable enough decisions from regulators on all these grid investments to justify that premium, even with the DCF and insider selling flashing warning signs?
That's the multi-billion-dollar question right there. Thanks for joining us on this deep dive into Sempra Energy.
Yeah, thanks for listening. And don't forget to like and subscribe to Stock Analytics AI. For just €4.99 a month, members get priority requests for deep dives. We're covering the entire S&P 500 over the coming months, and members get first look. And remember, if you just want a specific company covered, drop us a super thanks. And one last crucial point. This analysis was generated by an AI system purely for educational purposes. It is absolutely not financial advice. Please always do your own research or talk to a qualified financial advisor before making any investment decisions.